high yield credit versus the S&P 500, and the S&P 500 looking really resilient in the face of a bit of fragility in credit. What did you make of that?
Well, just the technical issue with this is that about a dozen names in the high yield index were responsible for about half the spread widening that we've seen last week. So a lot of it had to do with telecom, a lot of it had to do with media, a lot of it had to do with healthcare, and a couple of other sectors. So I wouldn't say this was a systemic risk that was starting to percolate into the market, but I will say that it did call investors' attention to the tight level of credit spreads. So at 428 basis points on the JPMorgan high yield index, for example, we're still above the tights that we've seen in June of 2007, which is about 266 basis points. But one thing I want to caution investors on is that we may not be getting back to those tight levels that we've seen back then. And the reason is, remember what happened post the financial crisis is the liquidity retrenchment at the same time when the demand for bond liquidity actually rose. So because of that, there's an illiquidity premium that now has to be accounted for and embedded in the credit spreads. And that's why I say we may not be getting back to those tights. And at these levels, we may have to start thinking about just how rich these valuations are.
So what's the strategy? You go up in quality, what do you do?
Well, the strategy is that you may use some of the strength that we're seeing in high yield in order to put on a hedge. So for example, we're looking at opportunities to take advantage of potential spread widening in the CDS of some of these indices. So the other reason to look at that particular opportunity is that if you do it in the options format, the implied volatility for positioning for wider credit spreads is very, very low. It's as low as it's been in November of 2006. So, there's an opportunity from low vol and, complacent markets, so to speak, and that is to add protection, to add a hedge, because there are risks, some of which can be foreseen and others that cannot. So we might as well prepare.
A lot of things that happened last week, though, revolved around the following. Credit risk came off, duration risk went on. I thought that was really interesting at the beginning of last week. Is that more risky to take credit risk off and put duration risk on?
I think both have elements of risk at this point, because I do think that the recent pause that we've seen in Treasury yields, I think that is just a pause. I think we will see shorter rates going up, and I also do see some upside to longer term rates as well, especially if tax reform passes. So sort of the playbook for higher rates to me is, if we see firmer inflation, which I do believe we see, that should cause the Fed to hike rates, and that should cause the short end of the curve to move higher. But if we get tax reform, which I also believe is not a question of if, but when, then I do think that boosts the real growth expectations, and that could boost the long-term rates as well. So I would be positioning accordingly as well.